Every time a business spends cash to acquire or produce goods, financial accountants face a strict dividing line. Does that spent dollar sit on the balance sheet as a capitalized asset, or does it drop immediately onto the income statement as an expense? International Accounting Standard 2 exists to resolve this exact dilemma. Its primary objective is to prescribe the accounting treatment for inventories, dictating precisely how much cost is recognized as an asset and carried forward until sale. If a company overcapitalizes its costs, it artificially inflates the assets on its balance sheet. This improperly defers current operational losses into future reporting periods, painting a falsely optimistic picture of the company's financial health. Conversely, expensing too much upfront suppresses current year profit while setting up a mathematical trap, artificially inflated profit margins in the future when that inventory is eventually sold. To prevent this manipulation, IAS 2 establishes a rigid baseline rule. Inventories must always be measured at the lower of their cost and their net realizable value. IAS 2 operates as a strict valuation governor. It is designed to protect the integrity of the balance sheet, ensuring that inventory figures reflect economic reality rather than aggressive accounting choices. The standard defines 3 specific categories of inventory: goods held for sale in the ordinary course of business, work in progress being produced for that sale, and raw materials or supplies consumed in the production process. It explicitly excludes certain assets. Biological assets related to agricultural activity and financial instruments are entirely scoped out, governed by their own distinct measurement standards. For everything else, application begins with the first half of the baseline rule, aggregating true cost. Defining the exact boundaries of what qualifies as an inventory cost is a required first step. You cannot test if an asset is impaired until you have accurately measured its initial value. This formula represents the core equation for capitalizing inventory under IAS 2. Total cost equals purchase costs plus conversion costs plus any other direct costs incurred to bring the inventory to its present location and condition. Purchase costs include the raw purchase price, import duties, and directly attributable transport and handling fees. However, trade discounts, rebates, and similar items must be strictly deducted from this capitalized value. Additionally, any taxes that the entity will subsequently recover from taxing authorities are strictly excluded from the inventory cost. The next variable is conversion costs. These are costs directly related to units of production, like direct labor, and variable production overheads, like indirect materials. While direct and variable costs scale cleanly with production, indirect fixed costs do not. This creates a calculation risk, and it is the exact point where companies frequently fail IAS 2 compliance. Fixed production overheads are indirect costs that remain relatively constant regardless of production volume, items like factory depreciation, maintenance, and facility management salaries. Paragraph 13 mandates a rigorous check on how these are applied. Fixed overheads must be allocated to inventory units based on the facility's normal capacity, rather than simply dividing them by the actual production output. Normal capacity is the expected average production achieved over multiple periods under normal circumstances, factoring in the loss of capacity from planned maintenance. Consider a period of low production, where a factory sits partially idle or underperforms. If fixed costs were divided across this smaller number of units, the cost per unit would artificially spike. IAS 2 prevents this. The unallocated portion of fixed overhead from idle capacity cannot be pushed into the inventory asset. It must be recognized immediately as an expense in the period it is incurred. The treatment flips during periods of abnormally high production. When output exceeds normal capacity, the amount of fixed overhead allocated to each unit is deliberately decreased. This ensures that the inventory is never measured at an amount above its actual historical cost. This allocation rule serves a specific defensive purpose. It actively prevents a company from hiding the financial drag of an inefficient, underutilized factory inside the carrying value of its inventory. Paragraph 16 of the standard introduces a list of absolute exclusions, identifying costs that are strictly forbidden from being capitalized. These include abnormal amounts of wasted materials or labor, administrative overheads that do not contribute to bringing inventories to their present location, and selling costs. Storage costs are also excluded and expensed immediately, with one narrow exception. if those storage costs are a necessary step in the production process before a further stage. Once the allowable costs are isolated, they must be assigned to specific inventory units. For goods that are not ordinarily interchangeable or are segregated for specific projects, entities must use specific identification of their individual costs. For large numbers of interchangeable items, IAS 2 limits entities to just two cost formulas: first in, first out, or FIFO, and the weighted average cost formula. Management cannot cherry-pick between these formulas to manipulate profit. The standard requires that the same cost formula be applied to all inventories of a similar nature and use across the entire entity. By stripping away waste, idle capacity, and selling expenses, IAS 2 forces the entity to calculate the purest possible mathematical cost, a figure now ready for the standard's ultimate impairment test. This returns us to the baseline rule. The carefully aggregated cost must now be weighed against the inventory's net realizable value. Net realizable value, or NRV, is the estimated selling price, minus the estimated costs of completion and costs necessary to make the sale. There is a strict definitional boundary between NRV and fair value. Fair value reflects a market participant exit price. NRV, on the other hand, is an entity-specific value. It is based on the actual firm's sales contracts and management expectations for realizing cash from that specific inventory. This impairment test is highly granular. Write-downs to NRV must generally be calculated item by item, unit by unit. Management cannot group inventories into broad classifications, like all finished goods, to use profitable product lines to offset the losses of obsolete ones. If the estimated NRV drops below the calculated cost, the asset must be impaired immediately. The difference is recognized as an expense in the period the decline occurs. This write-down enforces a core doctrine of accounting. Assets should never be carried on the balance sheet at an amount in excess of what they are actually expected to realize in cash. The final stage of the inventory life cycle occurs at the point of sale. When the inventory is sold, its carrying amount is derecognized from the balance sheet and recognized as an expense, cost of sales. In the exact same period the related revenue is recognized. But what if market conditions improve for inventory that has already been written down but hasn't yet been sold? IAS 2 mandates a new assessment of NRV in each subsequent period. If there is clear evidence of an increase in net realizable value because of changed economic circumstances, the previous write-down must be reversed. This line graph illustrates the strict mathematical ceiling on that reversal. The write-up is limited to the exact amount of the original write-down. The new carrying amount can recover, but it can never exceed the original historical cost. From aggregating initial purchase pricing to filtering out idle capacity, applying rigid cost formulas, and subjecting the total to the brutal reality of the item-by-item NRV test, the standard maps every step of the asset's life cycle. By policing the exact boundary between an asset and an expense, IAS 2 ensures that a company's balance sheet reflects economic reality rather than serving as a hiding place for operational bloat.